Hello, all, and welcome back to another lecture in our series for market risk. So, we are going to take a halt in our series for AML and KYC, and we are going to focus on the market risk chapter. And today, we are going to see one of the most important topics in the market risk domain, that is the VAR or variance at risk. And we are going to see how to calculate VAR using one of the methods, that is the historical simulation method. So watch the video till the end because we are going to perform the calculations in Excel. I'll show you. It's a very simple method. And also we are 5 subscribers shorts of reaching the mark of 900. So please do subscribe and like the video and watch till the end. So let's start. So what is VAR? VAR, or generally known as value at risk. This is a metric or a financial metric used to assess the potential loss in value of an investment portfolio over a defined period for a given confidence interval. So VAR is nothing but how your financial organization or your financial institute or the investors define or get the information that what will be the worst case scenario that they might face under normal market circumstances, that what loss or what maximum loss they can expect under normal market conditions. So that is known as VAR, and VAR is an important metric. It is used by many of the financial organizations in market risk. So this is what basically VAR means. Moving on. So, what are the components basically, or how do you read a VAR statement? So, we'll see how a VAR statement is written, but I just want to go ahead and talk about the components. So, the first component in a VAR statement, whenever there is a VAR statement given, is the time horizon. No one will come and say you that this is the VAR. That's not the way. So, whenever a VAR statement is there, it will encompass the essence of time horizon. That is, it will indicate the period over which the VAR is calculated. Say, is it a 1 month VAR? It is a 1 year VAR, or say 1 day VAR, or 1 week VAR, or say 200-day VAR, 300-day VAR, whatever it is. There will be a time horizon associated with the statement. Next is the confidence level. So this is where your organization or the investor or whoever it is, they will go ahead and ask, or your institute will tell you that we have calculated the VAR at certain level of confidence, say 95%, 99%, 90%. So what does this mean is that they are kind of 90% sure, 95% sure, or say 99% sure that that will be the maximum loss that the investor or the financial institute or the portfolio will incur. So the second point is the confidence level. The third is the VAR amount. Since a portfolio is associated with it, whenever you are getting a VAR calculation from any of the analysts or any of the organizations, you will be also getting the amount of the portfolio. Since a portfolio, say a portfolio is of say $50 million or 5 lakh rupees or whatever it is. So what is the maximum value that you will lose? It's not that 95% I'm sure that you will lose 1%. Okay, but 1% of that portfolio would have some certain values, right? So that value is also included in there, or say it will be there. So the portfolio value will be there. It will be not like that, say calculate 90% VAR. Of what, right? Of what are you going to calculate? So there will be a value of a portfolio or something. So in a short, these are the components that are present in a VAR statement. So, for example, this is like say VAR 1 million, time horizon 1 day, confidence level 95%. So, what is the interpretation? This means that there is a 95% chance that the portfolio will not lose more than $1 million in a single day. So this is what, when you break down a VAR statement, you can see, or the meaning. There is another meaning to it. Here it is. It shows that there is a 95% chance that the portfolio will not lose more than 1 million in a single day. Or it can also be told in a different way that there is a 5% chance that the portfolio will lose more than $1 million in a day. So both the ways you can analyze or interpret the VAR statement. So remember, VAR components and what is a VAR statement is read. Another example, VAR of $10 million at 99% confidence level over 1 day. So what does this indicate? This indicates that there is a 99% chance that the portfolio will not lose more than $10 million in a day. Or in a alternate way, we can say that there is 1% chance that the portfolio in a day will lose more than $10 million. So this is it. So this is how you can interpret VAR statements. Now, coming to the historical simulation method. So what is like historical simulation method? It is a method in which the VAR is calculated for a portfolio over a period of time, analyzing the historical market data that is available with us. So based on historic trends and the data points that are captured, we will go ahead and calculate the VAR using the historical simulation method. So how does it work? So the first point in historic simulation method is data collection. So we will go ahead in this phase and collect all the data of the assets in a portfolio. It may be a portfolio made of one single asset. It may be a portfolio made of multiple assets. So our first point is to go ahead and collect the data within the time period. Then there is the portfolio returns calculation. We will calculate the daily returns of what the portfolio has given us. So this is the second point, or the portfolio return calculation. Then we'll go ahead and simulate the portfolio returns. So this is kind of where we see what kind of information can be derived from this historical data, or what maximum loss or minimum loss can be present from that. Then once these returns are calculated, portfolio returns daily, we will be sorting them out. So we will go ahead and sort this from the worst to the best, that is the highest loss to the lowest loss, or from a negative loss to a positive loss. And then we will be going ahead and calculating the VAR or the VAR for that particular portfolio. So this is how a historical simulation method works. This is theoretical. Now let's take a live example. Since this is a calculation based approach, we will go ahead and check a kind of live example. So here I will be going and calculating VAR at different confidence level, say 95% and 99% on one of the stocks of with Reliance Industries, or on Reliance Industries basically. So say you are an investor and you have say 100,000 INR or 1 lakh rupees. You want to go ahead and buy stocks of Reliance Industries. Now you come to a analyst or any of the person and you are curious and you ask, hey, calculate the VAR for me. Say for, let's say I have taken an example of 257 days. Why I have taken 257 days? Because you will get 1 month, 1 week. Those are kind of what I can say, easily obtainable VARs. Like for let's say you will get tons and tons of resources calculating VAR for 1 week, 1 day, 1 month. So what if there is a VAR calculation which is in days? And such kind of days, say 257, 324, 500 days, 600 days. So that's why I have taken something different. So now let's go ahead and see how we are going to do this. So here I have pasted the link of the Yahoo Finance from which I have downloaded the historical data. So let me go ahead and quickly show you. So this is the data that I have downloaded from Yahoo Finance. It's relatively easy. You have to just go into Yahoo Finance and then click on download, taking the time horizon. So we have a total of 257 days of data. Let me show you guys. So as you can see here, we have data starting from 26th 7 2024 till 10/7, from 2023 till we have 10/7/2023 till we have till 26/7/2024. So this is kind of a 257 or 258 days of data. Now, how do we calculate VAR? So let's make a worksheet here. Let me rename it. Let's say worksheet. So here, as you can see, you have multiple data that comes from Yahoo Finance or that you get from the Yahoo Finance. So here is the date, the opening price, the highest price of the day, the lowest price of the day, the closing, the adjusted closing, and the volumes traded. So these are the data that you get from the Yahoo Finance. Now, for our calculation, we kind of need basically two datas or yeah, the first column. I'm going to copy this column, paste it in the worksheet. Then the important data that we need for a VAR collection is the adjusted close. So I'm going to copy this data and paste it over here. Now we have cleared the data of unwanted rows. So we basically need the adjusted close. Now what we'll do is, let me just go ahead and paste it as a value so that it does not get any issues. So let's see. Now the thing is, we have got this data, entire data. You can see we have the 257 days data. Let me just quickly sort it out and then can just, okay. Now we have this data. Now what we'll do from the adjusted close. Now we need to calculate the next step in the, so step one, get the data. Step two, what we did was adjusted close. We took the adjusted close data. Now step three, calculate returns, means daily returns. So I'll just go ahead and type here returns and we will go ahead and calculate the returns. So for this, basically, we will be using the simple formula. Now let's drag it all the way. So the third step is also done for us. We have gone ahead and say, for example, I'll color it in returns. Now let's change it to percentage. I'll keep two values over here. Now this is the third thing that we did is calculate the returns. Now the next thing that I do for simple purpose is I just make a column here, and what I'll do is I'll copy this data. Just let me delete it and I'll just paste the values. Okay. Okay. Let me copy and I'll just paste the values. Now, why I'm pasting the values, I'll let you know. Since I have the data, I'll go ahead and you can let it be there or you can remove. Now, the next part, the step 4, is sorting. This is very important in calculating historical data, historical simulation method. So I'll go ahead and sort it from, say, largest to smallest. Just give me a second. This, okay. So now we'll go ahead and sort out. So we have sorted the returns. So let me rename this returns sorted. So during a historical method calculation, always remember to sort out the data from the highest or the worst. That is the highest loss that the portfolio have suffered, and keeping go all the way down to 0, as you can see, 0, and then it should move up to the positive one. So this is really important in doing a historical method VAR calculation. Now the next step is we'll go ahead and calculate the VAR. We have completed all our methods. So the last step is, let's say we need to calculate VAR at 95%. For this portfolio, the portfolio value, say we need to calculate VAR for value, say 100,000. Okay, so for 100,000 or 1 lakh rupees. Now VAR at 95. So how can we calculate is, we will go ahead and see that we will go ahead and do the count function, right? Count, and we will see the total number of, we will exclude the last value because it do not have a kind of value. So we'll go ahead and exclude this. Now we'll go ahead and do the count. So as you can see, there are 256 data points here. So to calculate VAR at 95%, that means we will be taking 5% of the total data points. So we have 256 data points, and we will take the 5%, since VAR 95 is like, we will take the 5% of the total return. So this is the order 5% of the total return, and that whatever data point it corresponds to. So for us, it has correspond to the data point of, say, let me go ahead and check it here, data point of 12.8. So the 12.8 roughly comes to 13. So first, second, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th, 11th, 12th, and 13th. So this means minus 2.08 is our minus 2.0808% was our data point basically. Okay, so this is the maximum loss that we can expect in this portfolio. So let me go ahead and tell you. So we took the 13 data point, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So 2.04, sorry. So we will go ahead and do the D14 is our reading, 2.04%. This is the maximum loss that we'll go and get. So this is how we see VAR. Now, if we include the portfolio value, we have value at 1 lakh rupees or 100,000, and the maximum loss is 2.04%. So 2043.28 is the maximum loss in value over 257 days for Reliance Industries at 95% confidence level under normal market circumstances is what the VAR using historical simulation method is. Now, this is we did manually. How can we do using Excel? So VAR 95, we are going to calculate. So what we'll do is, it's a simple method. 1 minus whatever your confidence level or the VAR is, we will subtract it. Say 1 minus 95% into the total data count. Say the total data point or the days in which you are calculating the VAR. So it is 256 for us. See, we got 12.8 and 12.8 corresponds to D14. The sorry, we it corresponds to D14. That is the let me go ahead and color it out. 2.04%. So this is how we can calculate. So the VAR using Excel. So let me calculate VAR 99. So what would be VAR 99? Basically nothing. 1 minus 99% into the total data points. So you can see 2.56, or basically you can say the third reading, that is minus 4.12% is the reading that we are looking for here. This is in percentage terms. If you want to convert it into the amount terms, just multiply it into the amount or the value that is given. So 4117.53 is the maximum loss that you can incur while going with this portfolio for a period of 257 days with 99% confidence under normal circumstances. So this is how historical simulation VAR is calculated. So if you have any doubts, please comment down, and it's a very, very simple calculation. Practice it out, try it out. You will get more and more clarity. Try new scenarios in VAR, say 1%, 0.5%, 20%, take whatever readings you want. Just go ahead and calculate. And this was it for today. And thank you so much for watching. Please subscribe if you have learned something and do comment down. Thank you so much.